Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday 31st October 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Jack Greenslade, Deputy Head of UK, Ireland, Swiss and Middle East Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Lee, how are you?
Yeah, I'm good, Jack. How are you?
Yeah, good, very good. Another busy week. I can't believe it's already going to be November now. Feels like the year's flown by. And of course, another very busy week in markets as well. I guess starting with the long-awaited meeting between President Trump and Premier Xi. Both parties able to reach a trade truce in the end. What are the implications for FX markets there?
Yeah, definitely, Jack. I think this is one of the positive developments this week. It had been sort of reported ahead of the meeting that it was looking like things were heading for a positive kind of conclusion, and certainly that looks like that is the case. We have another trade truce this time for a longer period for 12 months rather than a kind of 90-day truce that we saw in the past. So that should provide some reassurance and certainty for markets that hopefully we won't see another kind of flare up in terms of trade tensions between the two countries going forward, although you can never completely rule out that risk. Additionally, obviously China as well has been able to secure a reduction in terms of tariffs on fentanyl, down from 20% to 10%. In response, China's also agreed to delay the implementation of export controls on rare earth minerals. So a win there for the US. But overall, I think for markets, we'll see this as a positive development. It reduces kind of downside risks from global trade and should reduce downside risks to global growth. So from an FX market perspective, I think this is a supportive development for the renminbi and also kind of other Asian currencies, which are more tightly linked to the growth of China's economy. And similarly as well, those kind of commodity-related currencies which rely on demand from China, such as the Australian dollar, should be supported by these developments.
Yeah, of course, you mentioned outperformance in Asian currencies. The one Asian currency that hasn't outperformed being the Japanese yen. I guess that's probably on the back of the Bank of Japan showing no urgency in hiking rates following their meeting this week. But since then, we've had Tokyo CPI inflation surprising to the upside. We've had verbal intervention from Finance Minister Katayama. You would have thought there'd have been some sort of retracement in the gains we've seen this week. So, what's behind the sort of lack of bearish momentum in dollar yen after these events?
Yeah, like you say, I think we've had a big move higher in dollar yen really this month. I think the yen's down by about 7% against the dollar, with dollar yen moving back up towards the 154 level. So to us, this kind of reflects kind of ongoing kind of optimism that the new government in Japan under Prime Minister Takaichi is still seen as likely to implement kind of bigger fiscal stimulus, which is having a negative impact on the yen. And I guess the BoJ meeting this week as well has kind of played into the view amongst market participants that they'll remain kind of cautious about hiking rates further going forward, potentially coming under some pressure as well from the government there to slow down the pace of tightening. Having said that, though, we still think there's a chance that they could hike rates this year in December. Obviously, if the yen continues to remain weak and if we see dollar yen jumping up towards the kind of high 150s up towards that kind of 160 level by the December policy meeting, that yen weakness could put pressure on the BoJ to respond and to bring forward plans to hike rates. So I think that would be certainly a more effective way to provide support for the yen and to reverse this weakening trend. But in the very near term, I don't think kind of verbal intervention alone will be enough to reverse the yen weakness. Like I say, I think at these kind of levels as well, we're probably still not quite there yet in terms of it's unlikely, I think, that Japan would directly intervene in the FX market and buy the yen at these levels. I think we need to see dollar yen, like I say, up closer towards that 160 level for the market to become a lot more nervous over intervention risk as well.
I guess that move higher has been driven by the dollar as well, especially after the Fed FOMC. So, turning to that decision that was released in the midweek, how do you interpret the Fed's more hawkish tone despite the rate cut?
Yeah, I think it's worth to reflect that there's certainly a bigger divide in terms of thinking on the FOMC about what to do next in terms of policy. Obviously, Chair Powell has had to kind of give some ground and kind of acknowledge some of the more hawkish voices on the Fed, who obviously aren't as supportive for the Fed to keep cutting rates. So he's certainly giving them a bit more airtime in terms of the guidance, where he said it wasn't a foregone conclusion that they'll definitely cut rates in December, which to us, that was always kind of the case. I don't think it was ever a done deal at this stage that they would definitely cut rates in December, and the market was kind of fully pricing in a cut. So we always felt the market had probably gone too far.
Yeah.
And it was always going to be kind of data dependent. At the moment, obviously, the Fed, like everyone else in the market, doesn't have as much clarity as normal in terms of how the economy is performing. We're still making the assumption, though, that if the shutdown ends with enough time before the December FOMC meeting, the Fed gets more information on the labour market. If we continue to see evidence there that the labour market remains weak, as we have been over the summer period, if that's continued, then we still expect that the Fed will follow through and cut rates in December. So for us, this kind of rebound that we've seen in the dollar, yes, it makes sense because the market's kind of priced out cuts for December. But like I say, if the data basically backs up the case for another cut in December and the Fed cuts rates as we expect, then we just don't see this kind of dollar rebound being sustained.
Yeah, it's quite a challenging job for the FOMC, isn't it, to make these decisions without the data, with the US government entering its fifth week of shutdowns. I guess finally, the next big central bank meeting will be the BOE next week. Sterling continuing to underperform into that meeting. What are you expecting from the update?
Yeah, I think next week is a kind of closer call than we'd originally thought in terms of whether the Bank of England will cut rates or keep rates on hold. Our base case scenario going into next week is that we still think they'll keep rates on hold next week, given that really since the summer they've been kind of signaling strongly to markets that they thought there was a stronger case now to slow down the pace of rate cuts. Admittedly, though, it's pretty clear that over the last couple of weeks, the macro data flow and events here in the UK have certainly opened the door again to more rate cuts from the Bank of England. We saw the other week the latest inflation data from the UK for September gave us more confidence that inflation is peaking for this year and at a lower level than the Bank of England had been anticipating. I think they would have been certainly pleased that food price inflation dropped more than they had anticipated in September, given that was one of the kind of upside risks they've been highlighting recently. And then as well, we saw further evidence there that the labour market here in the UK remains weak and that wage growth is continuing to slow. So things are certainly moving in a more positive direction from an inflation perspective. And then I think finally the other kind of development that we're kind of still watching closely is the fiscal developments here in the UK ahead of the autumn statement. And certainly the media reports over the past week have kind of reinforced our view that the government will be announcing a kind of more significant package of fiscal tightening measures. Kind of estimates are certainly in the region of say 30 to say 50 billion sterling in terms of fiscal tightening, and with the bulk of that likely to be tax hikes. We do think that will as well be more of a dampener on the growth outlook here in the UK going forward. And as we've heard as well from the government here in the UK, I think this time around they're obviously a lot more wary about kind of putting in place tax hikes that could kind of worsen the inflation outlook. So I think this time around they'll focus more on tax hikes which have less of an inflationary impact. So all in all, I think the Bank of England would obviously have to take that into consideration. That's why we think probably wait until December to cut rates. That's kind of been our call for some time. By then, obviously, they'll have more information on what the government announced in terms of the autumn statement. So that's why we kind of lean more towards December. But obviously highlighting that it wouldn't be a huge surprise if they did cut in November now. I think, like you say, the data flow and the developments we've seen on the budget have indicated that there is certainly more of an argument for them to just keep cutting rates at the quarterly pace that they've been doing. So we've obviously seen the UK rate market move to price in more easing for the Bank of England going forward, and that's put downward pressure on UK yields and the pound over the last couple of weeks. So we see that continuing even if the Bank of England leaves rates on hold next week.
Okay. And my final question to you, Lee, have you got any trade ideas that you're recommending this week?
In terms of trade ideas, we're kind of sticking to our long euro sterling trade idea, which is working in our favour. We like to say we had been anticipating that the market would move to price in more Bank of England rate cuts, and next week we think the Bank of England will certainly give off a dovish signal, even if they keep rates on hold. So that should be supportive of our kind of long euro sterling position.
Great. Thanks so much for speaking to me, Lee.
Great, thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.